Yo, what up everybody? In this video, I'm going to be channeling my inner roaring kitty to break down the new finance film taking cinemas by storm, Dumb Money. I'm going to be looking at how real it is, the lessons investors can learn from it, and whether I think you guys should go out and watch it. Let's get into it. Hi, I'm Stephen White, a chartered investment professional, and on this channel we discuss tips and strategies to help you become a more effective, confident investor. Today we're discussing Dumb Money, a new movie I believe provides a high risk-adjusted return for cinema goers and investors alike. I just saw it last night and wanted to share my thoughts on the movie, how real it is, and the lessons for investors. And watch till the end to see if it gets top rating in my new proprietary rating system. So Dumb Money is a new biographical comedy drama film directed by Craig Gillespie, who has previously directed alt mainstream hits like I, Tonya, Cruella, as well as the Hulu TV drama series Pam and Tommy. So he's got a pretty good track record. Based on the 2021 book The Antisocial Network by Ben Mesrich, Dumb Money was written by two former Wall Street Journal reporters, Lauren Schucker Blum and Rebecca Angelo, who watched the GameStop stock phenomenon unfold in real time and were captivated by its David versus Goliath narrative. It's a story of a struggle between retail investors, the so-called dumb money, and big institutions and hedge funds, the so-called smart money. The battleground is the stock market, and specifically the stock price and market value of GameStop, the American computer game retailer. The big bad hedge fund managers, played with deadpan comedic brilliance by Seth Rogen and Vincent D'Onofrio, they've shorted the stock, meaning they believe the stock price is going to go down and the company will fail. And if this were to happen, their funds would handsomely profit. On the other side, you have a motley crew of millions of retail traders connected online via a Reddit forum called Wall Street Bets. And this community's champion is the main protagonist, licensed securities broker Keith Gill, who posts investment theses and stock commentaries online under the pseudonyms Deep Value and Roaring Kitty. Gill is played brilliantly sensitively by Paul Dano, one of my favorite actors, as an ordinary guy from a working-class Massachusetts town who took on the investing elite. As the GameStop stock price becomes more volatile, so do the emotional, psychological, and financial stakes for the market participants, the movie's characters. So how real was the movie? Leading up to the movie, I actually first watched the documentary on Netflix that covered the same GameStop saga called Eat the Rich, which I thought was an expertly compiled and faithfully accurate depiction of the GameStop short squeeze in 2021. And thankfully, Dumb Money is also incredibly faithful to the facts and the characters at the time. Paul Dano's Keith Gill, aka Roaring Kitty, really mirrors the bright, everyman integrity of the real-life Gill. He comes across as a thoughtful retail investor who enjoys sharing his investment ideas with a community of people hungry to learn about the often impenetrable world of finance. Where the Netflix documentary focused solely on the price action of GameStop and who did what when, the movie has a much deeper emotional layer which really hits home. In one scene, Dano's Gill is washing the dishes before his wife tells him to go and focus on his investment live stream. This shows there are real people with real relationships and often with benevolent or altruistic intentions behind the market. She believes in him and wants to support his efforts to pursue his passions and make money for his family. In another scene, Gill connects with his YouTube subscribers by admitting we've all lost someone. I lost my sister, he says. An important human detail not actually covered in the Netflix documentary. Gill represents the archetypal little guy that we all want to root for, trying to pursue his passions and support his family. I think the film also did an amazing job of capturing the frenzied, emotion-driven investing from retail traders using the Robinhood app. When asked by a friend if she's going to sell a winning position, one character, a nurse, says, "Diamond hands." In chat forums, diamond hands means having a strong hand. She can't stop looking at her portfolio and she's become emotionally attached. And another character says at one point, "If he's in, I'm in," referring to a post by Gill on Reddit. I also really love the hilariously robotic portrayal of the billionaire tech founders of Robinhood, Viad Tenef and Baiju Bhatt, played by Sebastian Stan and Rushi Kota. Sebastian Stan in particular excels in delivering tech entrepreneur mumbo jumbo. And it's hilarious that in the film, these two entrepreneurs have matching his Teslas, which is actually accurate to what they have in real life. The characterization of the hedge fund managers is actually pretty decent too. I used to work at a big hedge fund and you do come across characters like this, ultra rich guys who are kind of detached from like everyday reality, living in their own high society bubbles. One thing the movie didn't capture accurately for me was that hedge funds often are managing money on behalf of public pensions or endowments. So they're often managing money for teachers, doctors, nurses, university staff. So we shouldn't really celebrate when hedge funds lose a lot of money and go under. Sadly, they do wipe out a portion of good people's savings when they do. This aspect was captured more faithfully in the Netflix documentary Eat the Rich. One other thing the film probably didn't capture fully for me was how devastating this period was for a lot of retail traders. The nurse character thinks about selling her winning position at one point, but decides to hodl, a retail trader mantra for holding on for dear life. The stock price drops dramatically afterwards, and the value of her portfolio plummets by hundreds of thousands of dollars. She started with nothing, and she's ending the film with nothing. In real life, many people bought in at the top of the frenzy and hodled all the way down, thus losing a huge amount of money. What are the lessons we can take from this movie for investing? Well, first, it reinforces the need to be appropriately diversified. You can make a lot of money in the stock market, but you can also lose a lot too, especially when you're over-concentrated. In the industry, a fund that would be considered concentrated would have 30 to 40 positions. And this movie really just talks about one stock and everyone kind of going all in on GameStop. By any measure, that is not responsible investing. The second lesson is to be aware of biases. I think the film does an excellent job of depicting different behavioral biases. In my opinion, both Gil and the hedge funds suffer from some anchoring bias and selection bias in their theses. Anchoring bias is where you're anchored to an opinion no matter what information comes through. And selection bias is where you only select information and data that supports your existing opinion. The nurse holding on when she should have sold is also an example of anchoring bias and something called ownership bias. As people, we instinctively attribute more value to things we own than to things that we don't own. The character that follows Roaring Kitty's lead when she says, if he's in, I'm in. That's a great example of following the herd. The third lesson is that taking profits is a legitimate strategy. In the movie, Gil has the opportunity to cash out at around $50 million, but he also hodls only to see his portfolio drop by nearly $40 million. As much of a hero as he is in this movie, that just isn't smart risk management either. If he'd have cashed out then, I would have celebrated for him. The biggest tragedy of the film for me is the story of the nurse who has two sons. She loses the opportunity to pay off her student loans, buy a new car, and create a more secure life for her sons. And this is the real human cost of the market sometimes. They are risky. The fourth lesson is beware of free trading. It's not actually free. The free trading offered by Robinhood in the movie is slightly glossed over. It's a complex topic, to be fair. But what starts as a benefit for users later becomes a cost when users are frozen out of buying GameStop due to Robinhood's balance sheet liquidity issues. So the app that promised to democratize investing actually ended up costing people real money when it caused a market panic and a sell-off. And the fifth lesson is that investing for the long term is best. I think the GameStop saga really again highlights that investing is really best looked at as a long-term practice rather than a short-term get-rich-quick scheme. I agree with Keith Gill's famous congressional testimony that the little guy should be able to make a fortune in the stock market, nothing more. But it's clear that people were just buying for the fun of it without doing any real research, and often just buying and holding out of spite to hurt the hedge funds that have built up short positions. I'm really glad some people got rich quickly, but these people will be in a minority, and most people would have lost money during this episode. It's also worth mentioning that a lot of hedge funds would have made a lot of money during this period. So, how do I rate the movie overall? Well, I think in terms of realism, I'd give it an 8 out of 10. It's really faithful to the source material. It's very closely linked to the Netflix documentary, and it adds really wonderful color around the human aspect, around the characters and what they were going through at the time. As this is my first finance film review, I'm introducing a new proprietary rating system for finance films. The top rating a film can get is AAA investment grade. That's a film that I unequivocally recommend. The next rating is BBB, also investment grade. It's a movie I really like, but it's not the best of the best. The next rating is CCC. This is known as junk or high yield. You know, sometimes movies are just so bad they're good. And if you want to take a big punt in the film market, I'd recommend films with a CCC rating. And the last rating is D for default. These are films that I believe have filed for bankruptcy, either morally or on creative grounds. I do not recommend them. So to kick off my first finance film review, I'm delighted to be giving Dumb Money the highest rating possible, a AAA rating. I may not like the stock, but I love the film. If you want to learn more about the investing biases that I referred to in this movie review, then you can click here on this video which talks about the investing habits keeping you poor. And if you'd like to learn more about investing responsibly and in a diversified way in the US stock market, you can watch this video next on ETF and index investing in the S&P 500. I hope you enjoyed this. Until next time, keep investing selectively and effectively.